So for our trust, I'm importing a balance sheet and profit and loss with some basic investment income in it. And you'll see in a second that all we really have is some interest and some bank charges associated with the interest, and not a lot on the balance sheet. So this really is an investment vehicle. We've classified that revenue as interest, and the bank charges, so I'll just go Control F to find my bank charges, and you can see I've classified them to indirect cost bank charges, but I've tagged them as deductions relating to Australian investment income. You'll see why in a moment. So now if we head over to Forms, let's just start this from scratch. Now, something you'll note is I took particular care to remove anything relating to business. If there's even the slightest hint that there's business income or something associated with the business, like accounts receivable or inventory on hand, the business module will activate, and there's no way to unactivate it except by removing the facts associated with business. So really the interest tag should, or this interest section should activate automatically. It's something we've got to sort out in the system, and we will. Now what you see is now we get the, so this is where it can get a little bit confusing in logic, because you can see we've got a $5 loss. The reason for that, and you can see there's no business activated here, right? So the only income in here is investment style income and investment style deductions. And you can see the Excel bank charges have classified in, creating the loss, but then you go, well, where's the interest income? Especially given that, what do we see here? We see that we do have the interest earned, but what we don't have is we don't have the taxable income. Maybe this was NAB interest, and maybe there could have been some TFN credits. But regardless, if this is the same, so be it. It could be different, especially in the case of some other kind of investment income, maybe like, for instance, a trust distribution. It's quite likely the accounting values and the tax values are different, and that's why we give you this capability, right? So actually that's 34. So you could see here we've got no difference now between the accounting and the tax values. And if we look in the reconciliation section, so we've got 34 minus 5 is 29, right? So this is 34, yep. And the $5 that we had as the deduction. Now, if you see what we're seeing in the reconciliation section, the accounting profit loss is $29 and the tax profit loss is $29. And you can see here what happens is the system goes in and out. So it adds the tax related investment income, and it subtracts the accounting related investment income. And it does the same here. It subtracts, well, I guess it subtracts the tax related investment income, and it adds back the accounting related investment income. So overall, there's no difference between the accounting and the tax. That's the way you handle interest and any costs associated with the interest. You get this kind of pattern. And it is possible that these variables are different. The accounting and the tax variables are different. And you'll see that later when I run through a trust distribution example. Now, of course, there are other things to worry about in here, like for instance, sharing out the beneficiary or the income with the beneficiaries, the taxable income, and reporting the reporting the trust estate income, okay, which in this case would be the accounting $29. But needless to say, you've got to focus on the reconciliation section and making sure you get the taxable values in.